Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Mr. Daniel Yu, Global Strategist at Yuanta Securities. Mr. Yu, good afternoon. Thank you for making time on this Friday.
Good afternoon.
Well, the pain continued in stock markets around the world on Thursday. We had GDP data in the U.S. confirming that the economy shrank in the second quarter, making it clear that America's in a recession. Tech shares on the Nasdaq were down more than 2.8%, S&P more than 2%, and the Dow about 1.5%. What's the story in the global equity markets?
Yes, the U.S. equity market declined sharply on Thursday, with the Dow Jones falling about 500 points, while the S&P 500 and Nasdaq lost about 2.2% and 2.9% respectively. This has occurred because of the continued uncertainty about the Treasury yield resuming its rise, outweighing the Bank of England's emergency intervention in UK notes. If you look at the volatility index, the VIX index, it also sharply risen to panic signals were picking at above 33 level. I think the continued uncertainty remains because of the higher than expected inflationary data, with the core PC price rising for the second quarter above expectation, and that is causing the concern for inflation being much more entrenched. And also, if you look at the jobless claims numbers, it continues to show that the economy can withstand this kind of higher interest rate environment with the very low unemployment ratios. It seems that the continuous hawkish rhetoric is coming out from the Fed policymakers about the central banks continue to be battling against the inflation, and this kind of trend could last for a longer period of time as long as these inflation numbers remains very high. I think the market-wise, a lot of people are saying that the Fed is tightening too much, but I think that the Fed policymakers are continuing to saying that a lot of numbers that are coming out still indicates that inflation is very high. Of course, these numbers might be a bit of a lagging factors, but nevertheless, I think that people are quite uncertain about what Fed might do, and Fed will cause the continuation of economic recession until the inflation is under control.
It does seem like they're willing to do that, but today less of a decline in Korean stocks, still touching a new low for the year. Shares of Samsung rebounded by almost 1%, SK hynix by more. We saw the currency climbing back up a little bit. Tell us about the domestic market.
Yes, in terms of the KOSPI falling, it didn't really fall as much as U.S. market. Main reason for that is because it's at very cheap valuation territories. We did see foreign investors actually coming back quite aggressively of the market today. Foreign investors net bought about 166 billion of KOSPI and 95.5 billion of Nasdaq, and that resulted into KOSPI falling by 0.71%, Nasdaq falling by only 0.36%. If you look at the local institutional investors, they are net buyer of about 106.5 billion of the KOSPI. Retail investors are the main net seller of both market of KOSPI and Nasdaq, amounting to 281.5 billion for KOSPI and 65.7 billion for Nasdaq. I think that net buying is coming into particularly battery sectors such as semiconductor. We saw foreign investors buying of Samsung Electronics and SK hynix of quite sizable amount. And if you look at the currency-wise, it is at 1430. That seems to be quite overshooting in terms of the undervaluation of the Korean won versus U.S. dollars. A lot of people continue to worry that net export being negative territories, and we are having a trade deficit. But if you look at the level of the government debt to GDP ratios and overall economic growth rate expectation, Korea seems to be reasonably okay relative to global economy. So I think that a lot of the uncertainty is already priced in, particularly KOSPI trading at 0.8 times the book value, which is actually as low as the 2008 financial crisis that we saw in several years ago. So on that basis, we think that foreign investors are quite interested to see some good asset purchases, and that's what's happening right now.
Well, meanwhile, oil prices are down ahead of a meeting of OPEC Plus. There's the prospect of lower demand for oil, of course, if the economy is doing poorly. And the price of gold, which we think of as a safe haven, also down significantly from its recent high. What do you see happening with the prices of these commodities?
Yes, if you look at the overall oil prices, has declined to well below $90 per barrel, and it actually corrected below the level of Ukraine-Russia war. So I think that that's clearly indicating that a lot of disruption in terms of the supply side has been corrected, and supply and demand side seems to indicate that oil price is not going to be in any position to further rise. Of course, OPEC Plus are meeting on October 5th. And Russia, keep pushing, saying that they're lobbying the group of slashing the output by 1 million barrels a day. Obviously, that's their sources of the money, so they will continue to push in such a way to keep the oil prices higher. But I don't see that actually could happen in a longer-term basis, on the basis that a lot of things have changed. Supply chain of the oil has changed significantly. If you look at the European side, they will be banning Russian oil quite quickly towards the end of this year. And if that's the case, we see that a lot of this supply disruption is already corrected, and that Russia will be in a very bad situation. We think that this will continue to have implications that oil price remain at much below what used to be before the war. Overall, we are seeing the commodity prices implication to the overall inflation pressure will be coming down quite quickly, and therefore we think that this could be a good news in terms of the liquidity conditions. As far as the dollar is concerned, of course, the dollar and the gold obviously has quite a bit of a relationship. We are seeing continuation of very strong dollars, which indicates that the commodities such as gold will be losing its value, and that's what's happening. Usually, when you have very tight policies, and also when you have a very significant changes in terms of monetary policies, and there's a worry about recession, the gold tends to rise. But it seems that because of the very strong dollars, we think the currency are gaining more interest rather than actually holding to gold. So metal seems to be down quite significantly in a few months or so. We don't see that gold is rising at a significant speed because there's quite a bit of a substitute for the gold for the time being, as the cryptocurrency as well as the U.S. dollars are continue to be in interest. So we'll see how that plays out. But nevertheless, the gold as being of a safe haven investment, it doesn't work for the time being.
It's a really interesting situation. All right, Mr. Yu, we'll have to leave it there for today. Thank you, as always, for sharing your insights with us. Have a great weekend.
Thank you. You too.